Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 13th, 2023. It is 11:55 a.m. Eastern Time. I'm starting the video, and what I'm going to do is some updates on some of the current trading opportunities. Unlike most videos, I usually start out with the equity markets. There's actually some new developments. Some old indicators I've shared in the past, but I haven't covered lately, and some updates there, as well as some key stocks and previous trades. I want to do updates on those and kind of wrap that into a broad market coverage. This will just be that kind of potpourri, mishmash of different current trade ideas, where the opportunities are right now, and then we'll get to the equity markets on a follow-up video. Okay, start out with the metals because we're right at that 22.55 target on silver, and like I said yesterday, we gapped up above that 21.50 level. I had in the update I gave you yesterday, which is right here, mentioned that we had taken out that 21.50-ish level that was laid out back here after the divergent low. And it was, if I give two different arrows, a brighter arrow color with solid lines, that's a preferred or primary scenario. Said, you wouldn't want to chase the gap if you didn't already have a position in it. Wait for a pullback, and that was again an alternative scenario. So we never got it, but we powered on up, and now we are at resistance. In other words, we were in what I call no man's land, or technical no man's land, on a stock or security. That's when you're smack in the middle between support and resistance, and that's just not an objective place to usually enter along. But we've come full circle. We continued up, and we did now hit that 22.55 level. So I wanted to point that out. And brief momentum fueled overshoot, that's another term I've made up, where you just have a lot of upside velocity or momentum going into a resistance level. You're likely to slightly overshoot it and then settle back. And we're on it now. We're at 22.56. So there's an area where, again, odds of reaction are pretty good. You can see it was support here. We broke that support. There was a leg down. Had a back test there, got rejected, and we're on it again. So ultimately, I do think we carry higher. These charts are constructive, big divergent lows, but I think we'll get a pullback first in between at this point. The gap, and again, the top of the gap right there, today's gap, yesterday's, and maybe all the way back to 21.49. Those would be objective buy points. You may not get them, but if you do, then that would be objective for a swing up to the next level. Gold or silver, like I said, that's usually what I'll go with if I'm bullish on gold, just because you get more bang for your buck. It's up 2% almost right now. It was up a little bit over that earlier, and then gold is already, it was up earlier today, now it's down. See, gold smack in no man's land right in the middle there, and still shy of that 183.77 target. So I think the sellers will step in and sell silver, take some profits there. Gold, if you get a pullback, there's also a gap right below. This would be, anywhere kind of by the dip mode, because they're coming off these divergent lows. But what you don't want to see is it fall back below the downtrend line. And, depending on where you went in, you may not want to even wait for a back test of it, because back tests come in at lower and lower levels. The other metals mentioned yesterday, platinum also at resistance, hence another reason if you were in this one, take some profits. I had that 90.30 target right there. We're at that, pretty stretched in the near term, so probably get a little pullback in platinum. But ultimately, like I said yesterday, the charts look constructive. We're coming off and you can see the resistance right there too. I have it at 90 on the daily chart. So getting a little stretch near term. Definitely wouldn't be a buyer at this point, more so a seller. If you're an active trader, take profits, or just raise stops, let it run. Sometimes these guys will go. Palladium, again, it was updated yesterday, daily chart, divergent low, breakdown, a breakout here, low level back test, and right above this 116.85 support, in which any pullback to that level or just below here on the gap, down to about 116, but I wouldn't be buying it below that. That would be your objective add-on. So there's the metals. Like I said, probably stall out. Just take a little breather here, because silver and platinum are at resistance, and that would be my best guess. Other than that, they still look constructive, intermediate term, looking out, in the coming days to weeks. What else did I want to cover for you? Those are the metals. Let's talk about the grains real quick. Wheat still back testing. That's what I told you recently. I said, the thing about a back test is you can continue to back test at lower and lower levels. That's what we're doing today. And again, what you want to see is an impulsive reversal off the trend line. And then ideally, you want to take out that former T1 that was already hit back here. T2 was hit. So I think if we can power on through here, take out T1, that'll open the door up to T2, T3. A T3 zone and T4 still have that big, large positive divergence at the recent low. Corn is just a correlated trade. Corn and wheat are the two big grains. They tend to move together. And corn, you also had that divergent low, big pop recently, and faded all the way back. That whole rally's been faded, but we're back to where we started. And the divergence that we had in place right here before the rally is not only still intact, the only difference is it's a little larger now because we've made a slightly marginal new low. For all intents and purposes, another pullback to that 2188 level, support level. And you can see the divergence now is even bigger. Indicating an even bigger rally if we can hold this level and rally off. So let me keep it very simple. It's an objective long entry here with a stop somewhat below. Somewhat is relative to your target. You can keep stops tight. You can use a more liberal target if you think we are in a new bull market in corn. Charts to me indicate it. And this is a long-term chart. Corn, like most other commodities, peaked back anywhere. A lot of them peaked back in the last bear market. This ETN only goes back, starts trading right here, so you probably would have had a high up there. That's when most commodities peaked. Been in a bear market. This was our bear market downtrend line. It's been taken out. Nothing goes up forever. You had a very healthy initial, what I believe to be initial bull run off the lows, or bull leg up, and followed by a correction, and most likely a resumption of the uptrend. So I'm just trying to paint the bigger picture. And again, maybe, maybe not. But the thing about maybes is that's it. You never ever know. And that's what well-placed stop will do, is keep your losses minimal in case corn wants to do this. And this is not a new bull market. And the energy complex, USO continues to move up. Crude oil, like I said, bigger pictures, kind of chopping around in a range here. We've been moving down. Again, long term, let's just do the same thing. Longer term, crude has been in a bear market, like all commodities, just about all commodities. It peaked back in 2008, clearly moving lower. And this is a weekly chart. And then by many metrics, including but not limited to the primary bear market downtrend line has been taken out. So you have crude flagging, if you will, right above this after the breakout and back testing the primary trend line. And so longer term from that perspective, it still looks good. Near term, you're really just like wheat and everything else I just covered, a lot of the commodities in what appear to be corrective waves. And I've many times over, I see some of the comments on the site since before and many times after this bear market started in the equity markets. My prediction was it's going to look a lot different. I say this, I repeat myself 100 times, the same comments on the site, is that I expect this bear market to be a whole lot different. And I think everybody, including the comments I'm seeing and the commentators on TV, are comparing it to bear markets of yesteryear. And I'm talking yesteryear, I'm talking nearly half a century going back to the last few bear markets that we had, the true ones, the 2007 to 09, 2000 to 2002, and even the one we had a kind of a bear market, if you will, from the late 60s, early 70s. That was the longest one. And I think we're looking at something more in the lines that Japan's lost decade, which was really two lost decades. If you look at it, started when the Nikkei peaked back in 1990 and fell for the next 2 decades. So again, I expect this just be a larger macro trend, and so these corrections, the bull market rallies and things like commodities that longer term bullish on, and gold and things like that, will most likely take longer to play out and convince everyone that it's a bear market, just like the bear market rally in equities as well. And then we'll have the next leg down will be longer in length, just like this bear market rally has been one of the longest in length on record so far. So that's crude. My opinion's not super strong right now, but what I'd like to see and well, whether I want to see it or not, you had these two divergent highs right here and quite a few reactions. Those are our most recent reactions. So USO needs to punch through with conviction, take out that 72.26 level. And at that point, it's going to start to, in my opinion, you can see it here on the daily chart as well. That's that same level right there. This is going to then reignite buzz about the inflation trade returning, the Fed having not being finished, because the consensus right now is that we're going to get another quarter point and then they're done. They've won the battle on inflation. And again, this is just because we've seen an abatement in inflation, and maybe that sticks. But if not, I'm telling you what to look for, and these are the things. And this is a big one. Crude oil has a probably of commodities, it's definitely the largest impact of all commodities on inflation and CPI. And then, of course, you have natural gas, still looking constructive, potential bottoming, base forming here, big positive divergences, already hit, first two targets, and it's just kind of consolidating. So near term, I wish the charts were a little bit more clear. They're not, but from this daily chart, it still looks constructive. Longer term, I just don't have any nearby, or an immediate opinion, as where the next, 3-4% goes. But I can say that if this, pans out, the divergences and the technicals on the chart, just like they did here, and sometimes they start to pan out. You get in the case of a divergent high, a drop. You go and make a marginal new divergent high, and then finally the bigger divergences play out for a much bigger drop. And that's a possibility here. Of course, I always say anything's possible. I try to speak in probabilities, and I think probability is, I don't know, whether it's coin toss odds. You don't want to ride that out if you are long. So that's where stops somewhat below, and somewhat is all dependent on your entry price. If I get a better read on something here, see some developments that happen soon, but I would say a reasonable stop right now, if you're in anywhere in this range, is somewhere right about here, 655 on UNG. You can see we had a gap there, an impulsive breakaway gap at around 655. Let's see if I can pick it up on this. Doesn't show as well here. Remember, you have futures that trade around the clock, and this is just tracking what the futures are doing between 9:30 a.m. and 4 p.m. But enough on that. I just wanted to kind of give you that update there, and then kind of bigger picture. Keep an eye on DJP. This is the inflation trade, at least via the commodities portion of inflation. And like I said recently, we're ticking up so far. The early makings of an uptrend. In the next video that I get to later on the equity markets, I did the same thing back in January. Told you we had the early makings of an uptrend when we were long and bullish, the big fangs, tech stocks in the market, and then said continue to watch it. Looks like that's the most probable scenario, and it was, and we continued in the markets to make an uptrend. So, but we don't have it yet, and we get a move above there, that's a check mark. You get a move above that reaction high, that's a check mark. And somewhere in here, right around here, is where the market will probably start to once again become concerned and turn their focus back to inflation. And that's probably going to align with maybe the next Fed. Still, if it's still a quarter point baked in, last time I checked, that was the probabilities. We'd get one more quarter point and then the Fed would be done. And so that's the big thing. So if we get it, and then commodities start moving higher, you're going to see again talks and worries about the Fed not being done. And obviously it goes the other way. If commodities start to go down, continue lower, start to take out things like key Fibonacci retracement levels, key support. This is DJP from a weekly chart. There's your big support. It's the price support level right there, that line, major reaction low there, major reaction high there. Once you broke it, another reaction high there, and we're back testing it now. It also aligns with a 38.2 Fibonacci retracement of the move, the entire initial bull run from the 2020 lows. So it's just right now a typical counter trend retracement. And if this bull market continues, it'll look something like this going forward. And that will be inflationary, rising commodity prices, gold, crude, natural gas, corn, soybeans, copper, aluminum, silver, cattle, etc. Okay, one of my favorite setups on the short side I've been harping on lately, and this one I gave you some real world examples, is Progressive. This morning I got a price alert. This one I gave you a couple targets here, T1, T2, and eventually I said T3. I didn't mark it up. I've covered this quite a bit in the last few months. And, my technical case was made. And that was this uptrend line right here, which clearly and impulsively triggered that sell signal today on the gap down. It was earnings induced. That's what I talk about. We're in earnings season. And I gave you my real world example where I believe that Progressive is understating their loss exposure to Hurricane Ian. It's been, we're smack in the middle of or back to hurricane season here. And it's been not quite a year yet, but coming up on that. And that was one of the costliest hurricanes in history. And of course, I gave you an example where the final settlement we got, having to bring in a public adjuster like everybody else here. The insurance companies dug in their heels, used these fantasy amounts to try to settle cheap. And most people weren't buying it. So my point was that it's taken a while. They just reported quarterly earnings and they had a big miss. And I also looked and they cited an increase in premiums that they've been collecting. But yet what isn't reflected, two things. Like I told you, our final settlement was what was a multiple dozens of times, a dozen times higher or so than what they initially offered. And the other thing is we're being dropped. The letter came out. They're reducing exposure to the Florida market, to this market for hurricanes, just like State Farm pulled out of California and no longer offering new policies there due to the same things. It's global warming. You're seeing more forest fires out west and mudslides. You're seeing increased hurricanes here. Where am I going with that? Well, okay, so they cited increase in the number, I believe, of policies, but I don't think what's not priced in yet is my policy will expire. I think it's in January, as will many in Florida. So I think what you're seeing, we're able to get price increases through the state. States manage the insurance industry in each state. I just read today or yesterday, Farmers is pulling out of the state of Florida. So you have a lot of these companies. So yes, and those that remain in Florida were able to get price increases. Again, a lot of them went out of business, but they're also pulling back on their exposure. So they're going to have less premium coming in at the end of the day. Fewer policyholders. And again, you're seeing it across the state. So I've been bearish on this industry, bearish on this stock. There it is, down 13% today. That is a solid sell signal. And it wasn't one that got away this morning. We gapped down right to T1 right here. And we clearly gave it up now. That is an impulsive break. We have less than 4 hours to go. It would have to do one heck of a stick save to get back on that level, possible, but that's about a 6% rally to get back there. So that, what I'm getting at there is that opens the door now to T2 being hit. So any kickback rally to T1 would provide an objective add-on or new short entry there for a swing down to T2 and then ultimately T3, something like that. Now that's the daily chart. My weekly chart, again, this was covered in the past, was this trend line here. This is the same chart. Oh no, we're going back farther to 2016. Here's our larger, more significant long-term uptrend line clearly taken out. So just based on this weekly chart, my first stop on the stock is down here at about 108, just above there. And then ultimately that level will likely go, and that'll take us down to 85 or so. And yes, the primary or at least intermediate trend for the time being in the stock market remains bullish. But you know that the video that I'll get to in a little bit, we're going to update. We're going to look at some of the trade ideas thrown out on January 11th. That's when you know, we were bullish in mostly all long trade ideas except one in that video, I believe, and that was this one. And so at the time where, you know, we were buying, going long the FANGs, Apple, Amazon, and Tesla being my three top picks, overweighting the Qs. Likewise, in that video where I laid out a bunch of other, you know, trade ideas, mostly tech stocks, and some others as well. This one was a short. It was a short setup right here. And my point is that we've had a heck of a run in the market since January, but it's been a, you know, you can outperform by carefully selecting the best individual setups, both long and short. And that's what I think we're going to be looking at going forward. Best case scenario in the market. If it holds up, I think it'll become more of a stock pickers market. As I said, we've seen the market leading FANGs stalling out. We saw Apple break down. And so now you can see from the site in the last few weeks, last couple of months, I put out more and more individual trade ideas, some obscure sectors, some pretty much related to nothing. And that's what's moving. It tends to be lower quality companies. But this one back here, right after it was highlighted in that video, the short entry was triggered, and it's done, you know, and this is KHC, Kraft Heinz Company. And from there it fell 60, no, that was 17%, I'm sorry. It was from 42, the breakdown, all the way down there. It was about 17% drop. So the point is you can buck the trend, and, you know, it's just a clear pattern of, you know, this one, that's what I point out. Then you have these almost identical type wedges with the negative divergence, and then you get the trend line breaks. And as I said back then, this one has a history of when it breaks, it doesn't just meander its way down. It starts usually out with an impulsive bang, 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 and then the downtrend comes and you get your counter trend waves, and then it's over. At this point, I have no opinion on the stock, just trying to use the example there that even in a strong tape, a bullish tape, you know, a clearly bearish technical setup will play out, and vice versa. All right, and keeping this one short, I'm just going to jump over to that follow-up on the MJ. I'm not going to go through all the cannabis stocks. I did an in-depth video yesterday. No reason to do that. MJ is above the trend line, not by a whole lot. You can see it currently trading. We had a kind of an unimpulsive, well, there was some volume in the last few days, and that's the thing. It's starting to catch some volume. I should point that out. Like, if you can see down here, my volume bars, the last week or so has been the highest volume since going back all the way to here. And again, that didn't mark a bottom, but this is something after a prolonged downtrend, you want to look for increased volume, and especially coupled with a breakout. So a couple of these guys are moving, and again, you can trade them individually, go with the best looking setups. OGM, which broke out, OGI, I'm sorry, covered yesterday, broke out yesterday, closed above, and it's followed through today, and it's hit that first resistance level I gave you, 193, and still looking for, you know, more upside in this one. And a lot of these guys, pretty much calling them up to the 200-day moving averages, and there's some price resistance in there. HYFM is another one coming right up. It's up today, 8%, and it's testing that downtrend line I gave you yesterday. So again, a sector to watch as long as the music is playing, meaning that dash or trash. Lower quality stuff, fundamentals don't matter much anymore. The stuff with the best fundamentals like Apple and Alphabet and those, they've already priced that in. They've had their big rallies, and they're, again, kind of stalling out and going nowhere. And Apple still back testing, breakdown back test. And so there's no change there. Again, I'll do another video later updating the equity markets and show you a couple indicators that one of them just fired a kind of a warning sign, if you will, and we'll do that in the next video. Let's cap this one here. This has been Randy Finney with Right Side of the Chart.